Hi, welcome to Edupedia World. Today we are going to learn some more terms of accounting. The words we have covered today are expense, income, loss, profit, discount, both trade and cash, purchase and purchase return, sales and sales return, stock, goods, cost, voucher, trade receivables, and trade payables. Let's start with income. Income is any money received or to be received by a business except for the capital and loan. So money received by sale of products, money received as interest on fixed deposit, money received as rent on certain property, all these are revenue income. Other than this, sometimes a business gains out of selling its assets, like say maybe an old furniture or an old equipment. So such gains are also income for the business. Please note here that income does not mean only the profit part. It means the total amount received or to be received from sales or other sources as discussed. Therefore, income for a business can be divided in two parts. One is revenue income, which comes from normal operations of the business, and the second is gain from sale of assets. Now let's understand expense. An expense is charge against the revenue income for that accounting period. In one of my previous videos, I had explained expenditure. Whereas expenditure is any amount paid or to be paid to acquire something for the business, which may include assets, expense is related only to the revenue income. Money spent to buy an asset, or say for example furniture or plant and machinery, is an expenditure for the business, but it is not an expense for the business in that particular accounting period. Few of the examples of expenses are advertisement expenses, electricity expenses, stationery expenses, office rent, traveling expenses. So all these revenue expenditure done for day-to-day operations of the business are expenses of the business. Now let's understand profit and loss. In our previous slide, we have understood what's revenue income and what is expense. So in an accounting period, when we consider all the revenue income like sales, interest, rental income, and we deduct the related expenses. When we say related expenses, it means the expenses which are related to those revenue income, which are spent to get those revenue income. So when we deduct these expenses from the income, the excess of income left is known as profit. And similarly, when the expenses are more than the total of revenue income, the excess of expenses over income is known as loss. Our next word is discount. We all are very familiar with this word, as this is something we love to get when we make our purchases or when we go for shopping. Though the concept is same for business, but it is slightly different. Definitely in business also it means the deduction in the sale price or any kind of deduction made while selling the goods. But in business there are two types of discount: trade discount and cash discount. Trade discount is the reduction made by the supplier of goods or services on the listed price. This may be done as a trade practice or maybe because of good quantity order. So whenever this is done, it is known as trade discount. And when we book these purchases in our accounts, we never record the trade discount. We usually book the purchase at a net price after deducting the discount from the listed price. Now in any business, usually the sales are made at credit, which means the payment is not received immediately. And whenever we offer discount to our customer for making payment within a stipulated time or to pay early, This kind of discount is known as cash discount. Or after purchasing something, if we pay cash timely or if we make the payment timely, we expect certain discount from our supplier. So whatever discount we get from our supplier after purchasing because of timely payment or early payment is known as cash discount. Let's understand both types of discount by example. Say we need 10 ACs for our new office. We go to a big supplier and price of each AC is rupees 50,000. But since we are ordering for 10 ACs, we get a discount of 5,000 rupees per AC. So for us the net price is 45,000 rupees. Here rupees 5,000 discount is trade discount, which we got because of good quantity order. Now we need to pay rupees 45,000 each for 10 ACs. So total payment will be rupees 4,50,000. We get 15 days credit time from the supplier. That is, we have to make this payment within 15 days. But we decide to pay in 7 days. So the supplier will get the money 8 days earlier than what he had expected. But for making early payment, we expect some discount, and the supplier gives us 10,000 discount more on the total payment amount. So therefore now instead of paying rupees 4,50,000, we will have to pay rupees 4,40,000. This 10,000 which we have saved by paying early is cash discount. While making the purchase entry, we will not make trade discount entry because here we will show the net price of the AC as 45,000 rupees. But while making payment after 7 days, in our books we will definitely recognize this cash discount of rupees 10,000 and we will make entry for discount of rupees 10,000 also in our accounts. Now let's understand what is purchase, purchase return, sales and sales return. Purchase means the goods procured by a business for either manufacturing something or for selling it with or without processing. When we say selling it with or without processing, we mean trading business. What happens in a trading business? We purchase something, we either sell it as it is with profit or we process a bit and then we sell it at profit. Whereas in a manufacturing business, we buy various kinds of raw materials, then we process it further and then we sell it. So all these procurements are purchases for a business. Purchases can either be made in cash or in credit. And as the name suggests, purchase return is returning something we have purchased, something which has already reached our premises or our factory or has been dispatched by the supplier. So anything which we have purchased, we have done the accounting, but for some reason, say if the quality is not up to the mark, if the item is not as per the specifications, then this needs to be returned to the supplier and a proper accounting has to be done in our accounts. So such returns are purchase return. Sales are total revenue received or to be received against the goods we have sold or the services we have sold to our customers. Now after selling, if for some reason the goods are returned by the customer, then this is to be accounted for in our accounts and it is known as sales return. Again, the reasons can be as same as the purchase return examples I had given. Either the quality is not good or the specifications are not correct. Now let's understand goods first. Goods means the product in which a business deals, something which it is producing and selling, or in a trading business it is buying and selling. It does not include something which a business buys to be used in the business. For example, if a pen manufacturing business buys furniture for its office, then this furniture will not be termed as goods. But if a furniture trader buys chairs, tables or other furnitures and sells it, then for that furniture trader these will be goods. Therefore, the products in which a business is dealing in are goods for that business. Now let's understand stock. Stock is goods which are lying with the business at a particular point of time, or the goods which is lying in the hands of the business at that point of time. That is why it is also called stock in hand. For a manufacturing business, the raw materials, the spare parts, the finished goods which are not sold are all stock for the business when it's lying with the business at that point of time. Similarly, in a trading business, the unsold product or the unsold goods lying with the business are stock for that trading business. Our next word is cost. Cost is an amount which has been spent to get that asset, or an amount which has been spent to produce something, or an amount which has been spent in providing a service. For example, when we purchase a machine, the cost of machine will include the money we have spent on buying that machine, then the money we have spent on transportation of that machine, the money we spent on installation of that machine. So all these amounts spent to get that machine installed and ready for use is cost of that machine. Similarly, when we manufacture something in a business, all the amount spent up to the point when that product is ready to be sold is cost of producing that product. Now our next word is vouchers. Whenever we make an entry in our accounting system, it needs to be supported by a document, and the document which we make is known as voucher. You can see I have posted an example of voucher. The details we mention in voucher are like voucher number, the date of voucher or the date of transaction, then the debit account, the credit account, amount which needs to be entered, the narration or basically a short detail about the transaction, then who has prepared it, he needs to sign this voucher, then the authorized person for the transaction, he or she needs to sign the voucher. So this documentary evidence is known as voucher. Now let's go to our last slide, and here we will understand trade receivables and trade payables. While explaining few of the terms in my video today, I have mentioned sale in credit or purchases on credit. Usually while doing business, we sell our products to our customers, but the payments are not received immediately. Rather, it is received as per the terms of the payment or as per the terms of payments of the industry. Say maybe we will receive money after 1 month or 1.5 months. So all such amounts taken together which we are supposed to receive from our customers is known as trade receivables. For example, maybe in one accounting period or in 1 year we have made sales worth rupees 10 lakhs, but during the year or at the end of the year or at the last date of the accounting period, the total amount we have received so far against the sales of 10 lakhs is rupees 8 lakhs, and this is our first year of business. So remaining 2 lakhs which we are supposed to receive from our customers will be our trade receivables. Similarly, when we make our purchases on credit, on the due date of the payment term, we need to make the payment to our supplier, but till then these amount outstanding or which needs to be paid to our suppliers taken together are known as trade payables. Please note that the customers who are supposed to pay us for the sales we have made to them, they are known as debtors of the business, and the suppliers to whom which we have to make payment for the purchase we have already made from them are known as creditors of the business. So that brings us to the end of this video. Thank you.